Hey, what is up? How would you like to pay off your mortgage in 5 to 7 years? There are several YouTube videos out there that indicate you can do this. However, the strategy that they advocate is not necessarily the strategy that you need to use to get $200,000 mortgage paid off within 5 to 7 years. So if you're interested in learning how you can pay off your mortgage in 5 to 7 years, stay tuned. So I want to welcome you to the channel, and before you do anything else, I would like to encourage you to hit that like button. Also, if you could not help but destroy the subscribe button, I would really appreciate it. It'd help the channel out greatly. We'll look up how these videos are doing that say you need to pay off your mortgage in 5 to 7 years with what they call velocity banking. Okay, you don't need to do that.
So if you go into YouTube and look up how to pay off your mortgage in 5 to 7 years, the first video that shows up is this one by Laura Pitko, and it has 6.2 million views. You also have the Kwok brothers with 1.1 million views, and this School of Personal Finance. Several of these look at the concept of velocity banking, which basically means that you use a home equity line of credit or a credit card to pay off your mortgage. You pay a big chunk toward it, and then you pay it off over a period of several months. So there are assumptions here. I'll link to the video with 6.2 million views in the description below, but you don't really have to do it the way that they say to do it.
So all of these videos come with an assumption. The assumption given in the one from Laura Pitko that has 6.2 million views assumes that you have a $200,000 mortgage that you are paying off for 30 years at a fixed rate of 6%. The first thing you need to do before you keep paying $200,000 off at 6% is probably go down to your bank, especially if you have pretty good credit in the 700 to 800 credit score range. You need to refinance. As I'm making this video in March 2022, the average home loan rate is right around 4%. So you could save money right there. I'll go later on and show you how much you can save if you refinance per month on your monthly payment, which allows you to pay off your mortgage even faster. So those are her assumptions. The other assumption is that you have a line of credit with an 18% interest rate, and you're going to put every extra dollar you have every month. She has an income of $5,000 with regular monthly expenses of $3,000, so you're paying off $2,000 toward this credit card or this line of credit every single month. And basically what you do is once it's paid off, $12,000 credit card bill, you use that, take a balance transfer check, or you just go and take out a cash advance and pay $12,000 toward your mortgage, and then use your monthly income to pay down the debt. You don't have to do it that way. And what I'm about to show you is how this can work, and you can pay off your mortgage in 5 to 7 years without actually having to use a line of credit or a credit card to pay off your mortgage early.
So for this video, I'm using a bankrate.com amortization schedule. You can pull this up. I'll give a link in the description below so that you can access it on your own. But I'm using, at first, Laura Pitko's assumptions. And these assumptions, as you can see here, are $200,000 mortgage, 30-year term, 6% interest rate. And the monthly payment for that will be right under $1,200. Now, if we go down to the amortization schedule, we can see that this will pay off on March 11th, 2052. That seems like a long way in the future, but trust me, it's not all that long. So anyway, when you do this with a 6% interest rate, $1,000 the first month is going toward interest. Less than $200 is going toward the principal. And every month you basically pay off a little more principal and pay a little bit less in interest. And if you just pay off the $1,200 a month in 30 years, you will have the mortgage paid off. So basically what she's telling you to do is pay off with a line of credit and add $2,000 basically a month toward your principal payment. You don't have to do that, okay? So how do we know that? Because if we go up here and we add extra payments, this is one of the things I really like about the Bankrate amortization schedule. If we add $2,000 every single month to our monthly mortgage, look what happens. We apply the extra payments. Now your estimated payoff is July 11, 2028 instead of 2052. You've paid off your mortgage in about 6.5 years without going through the rigmarole of adding, a line of credit and paying it off. Basically, all you do is you have that $2,000 of margin and you put it toward the principal of the mortgage, and that will allow you to pay off the mortgage in a little over 6 years, and that is at 6%. So let's look at this. If you use this method, you'll pay $40,000 in interest over 30 years. If we go back to zero added to the monthly mortgage payment and we pay it off in the 30 years that the loan is supposed to pay off in, you pay over $230,000 in interest. So you're saving a lot of money in that regard. So I recommended that you can go and refinance your mortgage if you go with the assumptions of a $200,000 mortgage at a 6% interest rate. So this is what that might look like. You would have to pay some closing costs, so I've upped the mortgage amount to $210,000, as you can see right here. Still the same 30-year mortgage, and now you got 4% interest rate. The monthly payment is now $1,002.57. So that's roughly $200 less than you would pay every month with the $200,000 mortgage at the 4% interest rate. If we look at it just paying out over the 30 years, you're going to pay a total of $150,925 in interest if you don't make any extra payments every month. So we could take the same $2,000 that you would pay extra, that margin that you have, and put it toward the mortgage, and also the $200 extra that you're saving on your monthly mortgage payment, and go with $2,200 every single month for an extra payment. So the estimated payoff, if you don't put that toward the mortgage, is March 11th, 2052, which was the same for the $200,000 at 6% interest. If we apply the extra payments, you only pay off the mortgage 1 month earlier. But you're still saving a lot of interest. You're paying $10,000 more in principal with the closing costs, but now you're only paying $27,355. You may wonder why you would want to refinance if you're only going to save a month over the other option. Well, you have more flexibility. Instead of being required to pay $1,200 a month, whether you have extra money coming in or not, now you're only required to pay just over $1,000 a month, which is a lot more flexible. So anyway, still, you don't have to use a line of credit. You don't have to use a credit card, and you're just paying extra every single month and paying off your mortgage in about 6 years and 3 months. That's a pretty good deal.
So, I hope this has been very beneficial to you. Hope you've learned something. Hopefully you can pay off your mortgage in 5 to 7 years. I have to confess I haven't used this strategy, but if I were to take basically everything that I'm putting towards retirement accounts and everything, I could probably make this largely work. But anyway, hope you have found it very educational, and if so, again, please just hit that like button, hit that subscribe button, click the notification bell so that you'll be informed when the next video comes online. Until next time, this has been Chris Hacks Life. Have a great day.